Welcome to another installment of Coach Yawe's Tweets. I'm Robert Yawe, a financial literacy coach with Quadrant Shift Africa. A lot of decisions are made hastily or sometimes without in-depth understanding. Last week I happened to be going through a presentation by one of the most successful investors on the American Stock Exchange. And he brought up an interesting point, which was that in 1919, when Coca Cola went public, the shares sold at $40. A year later, which is in 1920, the price of the Coca Cola share had dropped to $19. Now the question becomes, if you had made that investment, what would you have done in the year 1920? Would you have sold off the shares you held in Coca-Cola? Would you have given up on the company? Or would you look through the fundamentals and see if the fundamentals of the company still exist? Based on that, you'd be able to make a decision whether to average down, which is basically buy more shares at the lower price. That would be reducing your average price. Many of us in Kenya especially enjoyed the first 2-3 IPOs, which grew many in Kenya who started investing during the height of the IPOs made a lot of money with companies like Kengen. Then come more recently were companies like Access Kenya and Safaricom, whereby the shares shot up slightly and then suddenly started a downward spiral. This is the normal activity of a share, but because many people did not buy into a company but were buying into a speculative share, the minute the shares started dropping, two things happened. Some people dumped and tried to cut their losses. Others literally gave up on the stock exchange and walked away. To date, they hold 1,000 shares of Safaricom, which they sold at 5 shillings. And they all tell you how the stock exchange does not work. For those who understood that they were buying into a company, they knew that the fundamentals of Safaricom never changed. The company was still the leading mobile provider. So what most of these people did is they bought and bought and bought. Today, most of them might have an average price of 3 shillings and 50 cents or 4 shillings. But as of this recording, Safaricom is trading at 5 shillings and 55 cents. For somebody whose share price is 3 shillings and 50 cents, he's extremely... For somebody whose average price was 3 shillings and 50 cents, at 5 shillings and 55 cents, his portfolio is doing extremely well. So I think this is a lesson to most of us. When you go into the stock exchange, when you buy into a company, please make sure that you're clear about whether you're going in speculatively, because you're looking at capital gains, or you're going in for the long haul. So if you're going in for the long haul, look at the fundamentals of the company and let that effect decide whether you remain in the company, increase your holding, or exit the company. No one wins in a speculative market. Thanks for watching. I'm Robert Yawe, your financial literacy coach.